Hello, in this video we will talk about measures of risk. Let's start by asking ourselves a question. Well, a return of 35% per annum is certainly better than 20% per annum. And we can quantify it and hence we can clearly answer it. But then the question is, what about risk? Can investment risk be measured similarly as we measure investment returns? Well, the answer to that question is yes, it can be measured. In fact, there are two measures of risk, and they are standard deviation and beta. Let's quickly have a look and understand what standard deviation is. Well, standard deviation, as the name suggests, tries to measure deviation from the expected result. Example, if we were expecting that a stock will give 15% return and standard deviation is mentioned to be 10, then most likely, remember, most likely the stock should give somewhere between 5% to 25% return. The other measure of risk is beta. Beta basically measures volatility of a particular stock in relation to the market. Example, if beta of a stock is 1.5, then the stock is expected to move 1.5 times upwards or downwards as compared to the market. So if market moves up by 10%, the stock will be expected to move up by 15%. If market moves down by 10%, the stock will be expected to move down by 15%. In this video, we will discuss the concept of beta in detail, whereas the concept of standard deviation will be discussed in detail in the next video. As mentioned, beta basically comes from the volatility in the market. Now what you see here is a movement of Sensex right since January 2010 till July 2002. As expected, it's quite a volatile movement that we have here. Stock market goes up and down when most stocks go up or down, and over a period of time we can observe certain patterns emerge between overall market movements and the movement of that of an individual stock. For example, let us see this pattern. Here we have comparison of movements, market movements between BSE Sensex and ICICI Bank stock. BSE Sensex in orange color and ICICI Bank stock in the blue color. From 2000 to July 2012, we see that when Sensex goes up, ICICI stock has been going but much more higher than as compared to the Sensex. Over here we see that the highest that ICICI has been is up to 50% upside, when Sensex the highest point here is less than 25%, approximately 20% upside. But when Sensex goes up, ICICI goes up much more than the Sensex each time, and when Sensex falls, as you see here, ICICI also falls. Right, in a continuous falling spree, ICICI falls much more than the Sensex, and you find that the low of minus 22.54% as compared to Jan 2010 is made by ICICI, wherein Sensex has just probably come down by 10%. So what we can say from this is that beta of ICICI Bank stock is higher than that of Sensex. Now market beta is always considered as 1, and in relation to that, our calculations show that beta of ICICI Bank is 1.52. Now what does this mean? This means that it is riskier to invest money in ICICI Bank stock as compared to Sensex. Now let us have a look at this. Here we are comparing GAIL or Gas Authority of India Limited and BSE Sensex. We find that the two most of the time run parallelly to each other. In fact, there are few movements of deviation as well. For example, if you look at this place, GAIL is going up whereas market is going down. And again at this place, a repeat of this happens. Otherwise, most other places, they are quite moving hand in hand. Beta of GAIL is 0.54. So beta suggests that it is a comparatively safer stock to invest the money in. But then for a second look back at the diagram, 0.54 beta should ideally mean that the volatility in GAIL stock should be much lesser than the market. But we actually don't observe it over here. And why is that so? That is because market movements are not the only reason why stocks move up or down. Well, broader markets generally go up or down because of macro or systematic factors like market sentiment or geopolitical reasons or economic issues, etc. However, individual stock movements can also happen because of factors like increased competition in a micro market or labor related problems or changes in technology or preferences. So a low beta stock may become highly volatile due to unsystematic reasons, and a high beta stock might not be so volatile at point of time because of again unsystematic reasons. So reliance on beta alone might prove to be disastrous. Well, to actually know if we can rely on beta or not, we need to check a statistical measure which is called as R squared. Well, R squared tells us how much of the movement in script is because of market movements. For example, R squared of ICICI Bank is 0.7. R squared is measured out of 1. So if R squared is 0.7, that means that 70% of price movement in the ICICI Bank stock is happening because of market related movements, whereas R squared for GAIL is just 0.19, and that means that only 19% of price movements are market related, and hence you don't see a much lesser volatile stock than the market, even though beta is much lower at 0.54. So R squared of 0.19 suggests that we cannot really rely on this beta. In fact, let us take another important comparison. Here we see Bharti Airtel compared with Sensex. Beta of Bharti Airtel is 0.84, which means it should more or less move in line with the market. But R squared is very low, which means only 28% of Bharti stock movement is actually because of the market, whereas the rest is because of factors individualistic to the particular company, or which are also called as unsystematic factors. So if you see at various points of time, the stock and the Sensex are actually going opposite ways. So in a nutshell, what we have understood is beta shows volatility of a stock or portfolio in relation to the market or the index, and because it always considers index as the benchmark, it fails to take into account deviation caused by non-market factors. Beta of market is always considered as 1, and beta higher than 1 indicates a riskier stock as compared to the market, and lower than 1 indicates a safer stock as compared to the market. To know the reliability of beta, we need to check the R squared. A higher R squared means that beta is quite reliable. We can expect the stock to move as per beta. A low R squared means majority of the stock movement is actually happening because of non-market factors, and hence beta is not very reliable. That was all about measures of risk and beta. Uh, in the next video, we will talk about standard deviation as measure of risk. Thank you.